everybody. It is finally time once again to meet with Tatiana Ivleva-Lopez for our Mortgage Minute. Hello.
Tatiana.
Hola.
That's some hat you got there, amiga.
I know. Well, just to let you know, this is all I know in Spanish. I don't speak Spanish. For those who
I don't know. You did pretty good
yeah.
last night with the Vaquila.
Yeah.
What
Yeah.
Yeah, so happy almost Cinco de Mayo, right?
Yeah.
Yep.
So that's
Yes.
why I have this hat. Yeah, I'm just gonna put it off so everybody would start taking me seriously.
Now it's time to get done with it.
That's the hat I need when I'm out by the pool, like
Yes.
protect the skin everywhere.
Yeah, that's right. That's right.
All right, so tell us about rates. What is going on?
It's been a while. Yeah, tell us what's been happening.
It's been a while. Let me see.
Yeah.
Gonna share my
I was hoping that
screen.
was like your good news hat for rates.
Yeah, so the interest rates actually they went down slightly in the past week. For a couple of weeks they were going up. We had a pretty significant jump a few weeks ago, probably by 0.5%. So it's going down some. Conventional is at 6.92. Jumbo is at 6.63. So jumbo is lower than conventional. It's historically they low. Remember at one point they were actually higher. Oh, we can see it right here. So light blue is jumbo. So it's right here. They were actually well, somewhere. I don't know why it's not showing here. Maybe because it goes just back to January. I think last year, I remember we were talking about it, that this pink was actually over the blue, which is conventional.
Yeah.
But
yeah, I remember that.
Yeah, so jumbos are lower. I see more jumbos. I quote more jumbos to clients. So remember that in our area, jumbo can be anything above 802, 650. In our area, I mean in like metropolitan area, Washington D.C. metropolitan area.
Yeah.
Fairfax, Loudoun, Prince William, Montgomery, Prince George, like all like surrounding areas, even Fauquier. When you go farther out, then it's the limits are a little bit lower. Frederick County, it's already lower limits, but once you're at 802, 651, you can actually do a jumbo, or you can continue with conventional, high balance conventional up until 1.209, 750. So the difference, can I talk about that? The difference between, jumbo and conventional is jumbo typically requires higher down payment and higher credit score, more money in reserve. So maybe not everybody who qualifies for conventional would qualify for jumbo. But if they do, then they have option of going jumbo at 802, 651. So that's good to know. So so the rates dropped slightly, but the market is still very volatile. As of right now, actually, before we got on this call, I called my client saying that I recommend him lock in. And when you closing soon, when you can lock the rate once you have a contract, right? So in the long term, maybe it's okay to wait and see what's happening. But in the short term, the volatility is so high that you can't predict what's going to happen. And we always look at 1 year treasury, 10-year treasury yield. That's what actually the good indicator if mortgage rate is gonna go up or not. So if 10-year goes up, the interest rate is going to go up. So that's if you're watching the market and you're trying to think, you're thinking to lock or not, just keep an eye on 10-year yield, and then it will be pretty good indicator what's gonna
Okay.
happen, at least in the, today or
Near-
tomorrow with the interest rate.
Yeah.
Yeah.
Okay.
Okay. Have you seen a change in applications? Have you seen a lot of an increase or a decrease in applications?
The applications actually they did go down slightly last week and this week. I think it's sort of they were catching up with uh, people being on spring breaks,
Yeah.
right? And then we also had Easter, and in general, I think the higher rates and uncertainties,
Yeah.
what's gonna happen with federal government employees, and it's a lot of them in our area, or people that work for government contractors. So there's a lot of uncertainties, and with tariffs, how it's gonna affect the overall, prices on goods. I think
Mhm.
that makes people wait a little bit. So with that, probably, what do you see? Do you see it still seller's market or more
Well,
buyer's
it's
market?
well, if it's a little bit, it could be a little bit skewed just because of the spring break and Easter, like you said. But buyer activity this last 7 days went up, but inventory shot up, like 40% increase in inventory, and buyer activity only went up like 12%. So for this past 7 day period, we actually dipped down into a buyer's market. So we'll see if it stays there or what happens as time goes on.
Yeah, and houses are sitting on the market a little bit longer.
Yeah.
Like they're making it through week 1 and week 2 sometimes. So we think it's healthy.
Yeah, it's a healthier market
You know?
for buyers. Sellers probably like getting 20 offers, but they're still getting, if they present it right and they price it right, they're still getting top value and they can get multiple offers. But it's just they have to actually put effort into it and be advised appropriately versus just kind of throwing it on the market and letting everybody fight over it.
Yeah.
Yeah, I like your comment that it's healthier market, right? It's
Yeah.
definitely helps our buyers, and I see slowdown also in DC area. I think
DC
DC
huge.
itself is,
Yeah.
Yeah.
more
Yeah, we just put a client under contract in DC for the property been on the market over 30 days. Actually, we just closed on the property, but when they went under contract, it had been on the market over 30 days. But the seller still got their asking price. They had another offer in hand when we put ours in. So even though it was 4 weeks on the market, they got it's still good. It's just you gotta hit that sweet spot and have that buyer actually see it and want it.
But this is something, so within this one buyer's search criteria, and they were only looking DC, and they were open to like Old Town area. And I think we showed them one in Old Town, Virginia, but in DC, the other 13. So in one weekend, we showed them 14 properties.
That's right.
And this one stood out and they went for it. It happened to be the very last one we showed them because it was so well staged, and I mean it was just immaculate, and I think that's what it is. So Virginia, I think, is still a lot hotter than DC for sure, and I think it's still hotter than Maryland. What are you seeing about Virginia versus Maryland?
It's hard to tell because in Maryland, I work a lot in Maryland, but it's kind of scattered. Some in Montgomery County, some in Prince George County. So, and those are completely different markets. Yeah, so it's hard to tell, but I think you're right. I think Virginia is overall is hotter, especially areas closer to DC, like McLean, Vienna, Tysons, Arlington, all those areas, Alexandria.
Yep, absolutely.
That's true.
Agree.
Yeah.
So are you ready for a surprise?
Yeah, I was gonna say, do you have any surprises for us?
I'm gonna blow your mind.
Yay.
Let's see. All right. So, what if you are a self-employed person or and you show little on income on tax returns? You show a lot of deductions, so it reduces your income greatly. Or maybe you're in between jobs, maybe you are waiting for job offer and you're gonna get it, but you don't have it yet. and for some reason your spouse is not eligible to be on a mortgage, or maybe you're in retirement stage and you get in some retirement income, but it might not be enough to qualify you for something. So
Yes.
what we have is, so you don't have enough income to show, but you have good credit and you have assets. So
Okay.
that could be a different story, right? So we look at three pieces of puzzle. We look income, assets, and credit. If you don't have one, like income, but you have two others, we have a solution. And solution is asset depletion utilization qualifier. So there were 12% or 41 million Americans have net worth, excluding their primary residence, of at least $1 million.
Okay.
Just like I said, retirees, teachers, government workers, self-employed, anyone with assets that actually we can use those 100% of those assets regardless of their age or where those assets are. Are they in 401k non-liquid, right? Or they're actually in the liquid accounts. We can use 100% of that asset as income. So one example is here, the simplest method is when borrower has enough assets to cover 125% of all outstanding mortgage debt. For example, they don't have a current mortgage, right? But they're trying to get 400,000 mortgage. We multiply it by 125%, so that's 500,000. If they have 500,000 in their 401k, which a lot of people do, right? We could just use that, and we need to show, some additional for reserves, but we can use that as income. And they don't need to show any other income. So
that's fantastic.
I'm sorry?
I said, that's fantastic.
Yeah, it's great. So other options, couple of other methods. Method one, a borrower has 100% of new loan amount plus 36 months of mortgage payment, monthly, 36 months of monthly credit that came up on the credit report. Like, for example, again, a loan amount is 400,000. Borrower has $2,000 per month of debt on the credit report. So we multiply this $2,000 by 36 months, and we look at 400,000 loan amount plus 72,000 worth of 36 months of that monthly liabilities. So they need to show that they have $472,000 in their account. And that's what we will use to qualify them.
Okay.
Another option is alternative method is assets that is divided by 84 months, and we use that as income.
Okay.
So if someone has 500,000 in their retirement account, we divide it by 84 months, and it gives us $5,900, $5,952 of monthly income. So, and we can use that as income.
Right.
And the beauty of this program is that we actually can do a hybrid. We can mix and match. Like, for example, let's say this is somebody's actual example. Somebody has this 500,000. We divided by 84 months, and it gives us $5,900 income. But maybe it's not enough for them to qualify for a mortgage. But they also receive some other income, even that self-employed income, but it's just very small, or maybe they get retirement income. So combination of those two would be enough for them to qualify. So that's what we can use. And so the difference, regular conventional also has this method 2 option. However, the difference is they cannot use 100% of the assets. And it's if it's retirement, it needs to be 60%, and if it's investment like stocks, it's 70%. Also, they look at retirement, like what age you're in, if you're retirement age or not. So there's more limitations. Also, if we do a loan, conventional loan with Fannie Mae, they're gonna divide this 500,000 by 360 months.
Oh, the life of it. Okay.
And Freddie Mac would divide it by 240, which better than 360.
Right.
If for whatever reason this scenario is not working for a client, I'll go conventional with Freddie, which I actually recently did for someone, and it worked really well. It was just smaller loan amount. It was just easier to do it that way, conventional, than this program. But if somebody needs to, we can use this method, and it's just gonna work perfectly.
Yeah, I like this. This is a really great tool for you to have.
Is this for primary residence only, or can it be used for investment?
So this one is for a primary residence, and I would have to double check on that. Cut it out. I think it's primary and second home.
84 months versus 360 or 200. That's huge.
Yeah. So if somebody wants to dive into looking at this this type of loan, or any kind of loan, how would they reach out to you? What would be the best way for them to get in touch with you?
Give me a call, 571-245-3000.
Awesome. All right. Thank you so much. And we're going to get back on track with doing these mortgage minutes.
Yes,
so
every other week.
Yes, we're going to get it done. So if you guys have any questions for Tatiana, reach out to her, and we will see you in a couple weeks.
See you soon.